Did you know that in early 2025, variable universal life insurance premiums jumped over 40% in just a few months? That's one of the biggest shifts in the life insurance market we've seen in years. And it's catching the attention of families, investors, and financial planners all across the country. It's proof that life insurance isn't just about protection anymore. It's also becoming a tool for flexibility, investment, and long-term growth. Today, we're going to break down the four main types of life insurance: term life, whole life, universal life, and variable life. We'll talk about what each one is, how it works, the pros and cons, and how to figure out which one might fit your needs best. So grab a coffee, sit back, and let's make sense of it all. At its core, life insurance is a contract. You agree to pay the insurance company a set amount, monthly or yearly. In exchange, they agree to pay your loved ones a lump sum if you pass away while the policy is active. That payout is called the death benefit. And for your family, that money can be life-changing. It can pay off debts, cover funeral expenses, replace your income, even secure a child's education. But here's the thing, not all life insurance is the same. Some policies are straightforward and temporary, meaning they last a set period of time and then they're done. Others last for your entire life and even build cash value you can use while you're still alive. Choosing the wrong type could mean you pay for something that doesn't match your goals. But choosing the right type can give you peace of mind and long-term value. Let's start simple. Term life insurance. With term life, you pick a time frame, maybe 10 years, 20 years, even 30 years, and you pay your premiums for that term. If you pass away during that period, your beneficiary gets the death benefit. If you outlive the term, the policy ends. No payout, no cash value. So why choose a policy that might never pay out? Simple: cost and coverage. Term life gives you a large death benefit for a much lower cost compared to permanent insurance. That makes it perfect for covering big responsibilities during your prime earning years. Think mortgage payments, college tuition, or making sure your spouse can maintain their lifestyle if you're gone. Here are some key advantages. A. It is usually the least expensive way to get a large amount of coverage. B. It's the simplest to understand. C. It's great for temporary needs. But here are some drawbacks. A. It has no cash value. B. The premiums can rise sharply if you renew after the term ends. C. Once it expires, you are no longer covered. But some term policies let you convert to permanent coverage later without a medical exam. That's a big plus if your needs change. Now, whole life insurance, the classic permanent policy. Whole life lasts for your entire life, as long as you keep paying your premiums. And unlike term life, it has two components: the death benefit and a cash value. The cash value grows over time, usually at a guaranteed rate. You can borrow against it, withdraw it, or even use it to pay your premiums once it's large enough. That's why whole life is often part of a long-term financial plan, not just insurance. Here are some key advantages. It has guaranteed coverage for life, it has predictable premiums, and the cash value that grows tax-deferred. But of course, there are some drawbacks. It is much more expensive than term life, and its cash value growth is usually slower than other popular investments. Whole life is for people who want stability. If you like the idea of setting a policy in place and never worrying about it expiring, this might be the one. Next, universal life, also called UL. Universal life is permanent, like whole life, but it's flexible. You can adjust your premiums and even your death benefit within certain limits. That flexibility makes it attractive for people whose income or financial needs might change over time. UL also has a cash value component that earns interest. The interest rate might be fixed or tied to a financial index, and it can change over time. It has some of the following key advantages. A. The flexibility to change premiums and coverage. B. The potential for higher cash value growth than whole life. C. Sometimes the cash value can cover your premiums. But like all insurances, it has some drawbacks. A. It is more complex than term or whole life. B. If the cash value runs out because of poor performance or missed payments, the policy can lapse. So universal life is like a middle ground. You get lifetime coverage and flexibility, but you have to keep an eye on it. Finally, Variable Universal Life, or VUL. This one takes the flexibility of universal life and adds an investment twist. The cash value can be invested in sub-accounts, kind of like mutual funds. That means your cash value and possibly even your death benefit can grow faster if the investments perform well. The flip side, if your investments do poorly, your cash value can drop, and you might have to pay more to keep the policy active. Here are some key advantages. A, it has higher potential returns. B, you have investment control. C, there's flexibility in premiums and benefits. But some of the drawbacks are the following ones. A, it has higher risk. Poor performance can shrink your cash value. B, it is more expensive than term life. C, it requires active management and some investment knowledge. So VUL is for someone who's comfortable with market ups and downs and wants their insurance to double as an investment vehicle. So here's the big picture. For term life, it is short-term protection with no cash value but has the lowest cost. For whole life, it offers lifetime coverage with guaranteed cash value, but at a higher cost than term insurance. Universal Life gives you lifetime coverage, but also with flexible premiums and benefits, and the cash value is tied to interest. Finally, Variable Universal Life gives you lifetime coverage and is flexible as well, but the cash value is tied to investments, so it has higher rewards potential with higher risks. The world of life insurance is changing. Fewer people are buying simple term policies. More are exploring options that offer flexibility or investment potential. Younger buyers want policies they can manage online, and many are mixing insurance with their financial planning. But one more thing, many people are still underinsured. Some have no coverage at all. Others don't have enough. And a lot of this comes from a simple misconception that life insurance is too expensive. The truth? For a healthy young adult, a term life policy can cost less than a cup of coffee per day. But how to choose the right policy? Here's how to narrow it down. First, decide your main goal. Do you just want pure protection, or do you want savings and investment built in? Second, look at your budget. Can you afford permanent insurance premiums, or is term life the smarter move right now? Third, consider your time frame. Are you covering a 20-year mortgage, or do you want something that lasts your entire life? Fourth, think about your comfort with risk. If you hate market swings, a variable policy might keep you up at night. Remember, you don't have to lock into one forever. Many people start with term life and later convert or add permanent coverage as their finances grow. To sum it up, term life is simple and affordable. Whole life is stable and permanent. Universal life is flexible but needs monitoring. Variable Universal Life offers investment potential but comes with risk. The best policy is the one that matches your goals, your budget, and your comfort level. If this breakdown helped you, tap the like button, subscribe, and tell me in the comments which type of policy you think fits you best. And if you'd like a follow-up video on indexed universal life or policy add-ons, let me know. Thanks for watching, and here's to making smart choices that protect your future. Goodbye.